All right, good morning. Today is Wednesday, October 25th, 2023. This is our monthly client check-in. We call it our capital markets update and outlook call. So thank you for being here. We are live on our website. We are live on YouTube, LinkedIn, Facebook, and now X, formerly Twitter. So welcome and good morning here. Coming to you from a gloomy, kind of wet, cool Minnesota October day here. So again, today the goal is to hear from our Chief Investment Officer, Tom Fox. Tom is going to review the positives in the markets, the headwinds, as well as give us his outlook for the rest of this year and looking into 2024. Ultimately, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing in the markets and the economy, what we're watching for, and so on. So I encourage you, if you have any questions, to put them in the chat box. I will be monitoring that chat box. You're also welcome to email me if that's easier for you. I'll be watching my email and I'll be watching the chat box. I'll also be watching any comments under the video. So if you are watching on a social media platform, if you just comment, post a question in the comment section below the video, I'll be able to see those and get those questions to you. So who are we? Why should you care what we have to say? Well, if you're joining us for the first time, my name is Eric Hagan. I'm a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, of course, Chief Investment Officer Tom Fox, financial advisors Dan Oshman and Rana Grant, as well as our client support team, John Knudsen and Marilyn Westmark. Together, our goal is to help individuals, couples, and families make their next financial decision, and the one after that, a good one. So like I said, today, our agenda, very simple. We're going to look at the headwinds in the markets and the economy, and look at the positives, and then we're going to hear from Tom as far as the outlook of what it all means moving forward. Tom has an incredible resume, decades in the business, watching the markets, analyzing the markets, doing research, and providing guidance on what to do moving forward. So again, quite the resume. You can see his resume there on the screen. So with that, I'm going to turn it over to Tom. But again, encourage you, we would love to field any questions that you have. Please don't hesitate to post those questions that you may have in the comment section. If you're watching this in the recording, please feel free to post a question down below. We would love to circle back with you on any questions that you have. I know a lot of you watch this in the recording, so please don't hesitate. If you're watching this later, if you have any questions whatsoever, we would love to circle back with you on those questions. So like I said, today is October 25th. We are just barely a year from the lows of the market. I think it was October 10th, sitting here roughly 16, 17% higher from those lows. A lot of the experts out there were calling for lower lows. We were not in that camp. And so, and as history has shown, we were on the correct side of those calls. So definitely encourage you to pay special attention to what Tom has to say. Has a lot of important information for us. So I'm going to go ahead and bring him to the stage. So there we are. Tom, can you hear me?
I can hear you. Can you hear me?
Wonderful. Well, good morning. Yes,
Good
yes,
morning.
loud and clear. So we'll
Hello,
be hanging on,
everybody.
on
Good
every word
morning.
today. So thanks for being here.
Here we go. Good to be here this morning. A lot of things are changing in the world global scene, and we'll be talking about that and what our expectation is and what we're prepared to do. So, as always, we're keeping an eye on everything going on, and we're always looking at the pluses versus the negatives. Now, our theme has been for this whole year, Wag the Dog, and that is where something of lesser influence influencing something of greater influence, which we put in this case, the dog is the Fed, and the what's wagging the dog is something of lesser influence, which we believe is inflation, will eventually cause the Fed to stop raising rates. And we believe we're right at the door of that. In fact, they may be all done, but time will tell. But we're prepared for whatever the scenario ends up being. So the first, my list of wall of worry or growing uncertainties is getting bigger. Every month, there's plenty to talk about. Right now, we have the Israeli-Gaza war and the increasing risk of a potential expansion with Hezbollah. And that could happen, especially when Israel invades the northern part of Gaza. So we will see what happens in that scenario. But that is something to think about. And will the U.S. get involved? Well, we're certainly building up our military might on ships just outside of Israel and the Mediterranean. So it's expected to keep Hezbollah from getting involved. And Hezbollah has a great army. They have 150,000 militants, and they're all really good at fighting because they've been fighting in Syria. So, and they got a lot of better missiles than Hamas. So this is something that could end up expanding. It's very difficult to predict geopolitical events. So we'll just leave it as that. Now, student loans payments have started the resumption. And of course, that's going to take around $250 out of the pockets of many millions of students. So we'll see how that impacts the economy. Obviously, they won't be able to spend that $250. We're going to have to put it to debt servicing, which has been on hold. So we believe that will be a drag on the economy. And the fast increasing subprime car loan delinquencies. So currently, the subprime, that means less credit worthy people are losing their cars and going into delinquencies at a fast pace, and that's going up quickly. And sometimes that can be a leading indicator. And of course, the long-term yields have risen so fast. And when the Fed Chairman Powell spoke recently, he said he doesn't have an explanation for it, why the yields are going up so fast. So he was being very humble. So I'm not going to try to explain it, but I do have some charts on some of the factors that are causing the long-term yields to rise so fast. Now, the short-term U.S. Treasury yields and U.S. Treasury's 10-year yields are now so high that they're creating competition for stocks. Many people are getting very decent yields from just being in a short-term or intermediate-term bonds, although the total return for bonds has been going down because of the interest rate increases. But that has created some competition for stocks. And so would you rather be in the stock market or some fixed income? So that is also something we're watching. And the Fed will probably keep rates higher for longer. That's the economic scenario that's out there, that they're not going to lower rates until after July of next year. And that could all change, and our surprise forecast will speak to that. Oil prices could repeat like the Yom Kippur War of 1973. You remember, it led to stagflation and tripled oil prices. And so is that going to happen again? And of course, if the war expands, that could happen. So we're going to talk about that, but we're going to show you that the odds of that repeat of 1973 are very low. So Washington political circus continues, and that's worrying investors because you don't have a speaker in the Congress. And so something just happened this morning where a potential candidate has just emerged, Johnson, and he evidently has support from those who voted against all the previous ones. We'll see what happens, but we may even have a speaker this afternoon, but that's causing some stress in the markets. And of course, we have the government shutdown risk without a speaker. That's very difficult for Congress to make a decision on that. And then you've got the UAW strike in the automotive sector, and that's a lot of jobs. So if they're still striking, that causes economic pain at some minor issue, but it's still there, and that could be a drag on the economy going forward. And here's one: small business debt coverage costs are increasing. And we're going to look at some charts on that in our presentation today, that it's going to be tough for small businesses because many of them are on a short-term interest rate that's adjustable, which means their debt service is going up, which makes it hard for them to make profits going forward. So we'll talk a little bit about that, but that can be a drag on the economy. And also historically, when the Fed interest rate campaign to tame inflation gets going, it normally will end in recession. And we're going to talk about that, what we believe about that, but that's been the history, and we'll see what happens. I think it was just one time that it didn't end in recession, and we'll see give our view on that, whether or not we'll be ending in recession again. Also, the delayed impact of global interest rate campaign, which we believe is going to happen, that the Fed will most likely overshoot and the economy may get hit next year because of this high interest rate, spiking interest rate economy that we're in, and that there's a delay before it hits the consumer, before it hits all the other business aspects. So we think that this is a very strong possibility. And overall, many strategists are negative, and they've been negative for a long time. And those that were calling for a recession in 23 are not leaving that camp, and they're saying there's going to be a recession in 24 or maybe even the fourth quarter of this year. So many people are negative. They remain negative, and they've been out of the market. Fortunately, we, as Eric indicated, we've been in the market to capture a lot of the bull market returns, especially since October. It's been a pretty good run. Now, there are some positives out there. You can see that my list of positives is much shorter than the negatives. Inflation's still on a glide path downward. It's not going up, and we believe it's going to continue down. If rates start declining from recent highs, and we hit 5% on the 10-year Treasury yield for about 2 minutes, and then it dropped 20 basis points after that. It's making its way up into the 490. But we did hit 5%, but it may have already started. We may have seen the highs. We don't know. The Fed doesn't even know. So I'm not going to tell you that I know whether or not we'll go through 5% again. But right now we're about 490 something. So we still, is at the end, is that the peak of the interest rates? We think it could be, but we'll have to see. Stock and bonds typically rally. We'll see a chart on this after the Fed stops raising rates. And we are expecting, by the way, GDP is coming out very soon. And we expect a very robust GDP number. The estimates are high. We think it's going to be a robust number for the last quarter. But we think that that may be the peak, and things will be turning over from this point on. The Fed actually said that they expect a strong number. So they're expecting that. We're expecting that when it's announced. So don't be surprised if we get a super strong GDP number here in a few minutes. I think it's later today. AI will drive productivity gains, strengthening U.S. technology lead. I forgot one here. The U.S. consumer debt service ratio. This is the overall debt servicing. Their debt is at a 40-year low. So consumers' debt is not too bad. Now, on the other side, credit card debt is another story. There are increasing delinquencies, mostly in the subprime area, like the car loans. That is maybe a leading indicator, and we'll see how that shakes out. But right now, the overall consumer is in pretty good shape on how much debt they have to service. That's based on the pandemic savings and paying off debt. So they still haven't raised much debt in their families' overall balance sheets. Now, if the Fed is done, there's huge amounts of cash on the sidelines, could bolster stock returns going into the rest of the year. There's an overwhelming number of investment strategists that have been bearish, missing the bull market. And if things are better than expected, will they get back in? That could drive prices up for the stocks. we'll see if that actually occurs. Now, I'm going to give you some reasons for a possible rally in stocks. And there's a few of them. Number one is that corporate earnings so far have been looking pretty good. They're beating analyst expectation. You can see that 72% of companies have beat the expectation. And they beat it by a pretty good size number, 6.2%. So earnings are coming in fairly good. Now, there's been some mixed earnings. For example, Microsoft came out with great earnings. So did Google, but the outlook for Google was a little lower, and their computer storage revenue has declined a little bit versus Microsoft has been going up. So there's a little difference between what's the price of Microsoft's going up, Google's going down on those numbers, although they have both beat the revenue and the earnings expectation. But we see that earnings are going to be good this quarter. We think they're going to come down a little bit next quarter, but no disaster. Now, here's some interesting stats. The second year of a bull market is typically good for stocks. And you can see, if you see the first circle on the left, it shows that this bull market's gone up 21.6% since October lows last year. And if you look at the next circle, that the average return for year two of coming out of a bear market low is 12.6%. What you'll also notice that there's no negative numbers. It's 100% of the time. Historically, we've had a great second year of a bull market following the first year. So one of the things I want to note is that you can see how low this bull market's been. It's been a kind of a lackluster bull market. There was another one, 87 to 90. It was 21.4, but typically the average is 40.3. So this has been on the lower side, not the lowest, second lowest historically. But what does that mean for the second year? Well, typically it's a decent year the second year, which we have just started this October. Many are worried about the geopolitical shocks that are going on in the Middle East. But if you look historically, the normal average for 1 month later is a positive number. How's the stock market done after Pearl Harbor, Cuban Missile Crisis, Six-Day War, Iraq invasion of Kuwait, and so on? There's a big list there. And what it shows is that the shock doesn't have any meaningful long-term issues for the stock market. If you can see, 1 month later was up 0.2% on average. 6 months later, it's up 0.3%. And then 1 year later, the average return for the stock market after these geopolitical shocks has only been 7% positive. So we've had a lot of shocks historically. However, it doesn't seem to last too long. And so we'll see what happens. Now, if Hezbollah gets involved and they attack with all their missiles and all their number of fighters, and the U.S. has to get involved, that could be another political shock, and that'll have a temporary impact on the stock market. But we can see that over time, it typically does okay over the next 6 to 12 months. Now, here's another reason. We talked about this. The U.S. household debt servicing costs are at a 40-year low. You can see on the right side of the chart, it's gone up slightly, but it's still very low based on history. Financial obligation ratio, historical debt service ratio looks really good. And you can see that it's been a lot higher in the past. So we're still at a decent number here. So the household debt is not too bad. Although, again, subprime auto payments are going into delinquency, and so is the subprime credit cards. So the lower end of incomes are starting to suffer, and we'll see if that is a leading indicator. But so far, it's so good. Here's another thing. Remember, we talked about the positivity of the Fed stopping to raise rates. Well, the probability of a rate hike by December now very low. It dropped after Paul spoke the last time to 25% probability. That means 75% are saying there's not going to be another rate hike. Well, this is a big change. You can see a drop below where we've been before. So what economists and strategists are saying, we don't think there's going to be another rate hike. And remember, typically, when they are done, stocks and bonds both rally. Now, here's another positive, because you can see, are we going back into oil prices shooting to the moon? Well, you can see the percentage of U.S. oil imports from OPEC nations was 70%. And there's Eric's family, or 70% in the 1970s. Well, it's only 12 to 14% in this so far this year. So you can see the dramatic decrease in dependency upon OPEC oil coming from the Middle East. So we think that oil prices will be contained. They will go up if there's a breakout and expansion of the war, but we think they'll be contained and nothing like the 1970s. All right, we're going to look at the rotation of stock leadership coming, and this is something that we are always looking at. And in fact, when you look at the thematic growth segment of the portfolio, we've shifted to a change in stock leadership. So we'll take a look at this, what's happening. And this is the high concentration. What percent of the capitalization of the S&P 500 is driving stock returns in the S&P? And you can see that 10 stocks are at a record high of influence in the S&P 500. That's why you've had recently, you've had such high returns, 30% plus in some of the biggest stocks in the S&P. So they've gotten bigger and a bigger percentage of the influence of return. What that means is there's going to be opportunity because of the underperformance of the other stocks. We think that the other stocks will begin to outperform. And we've already made some positioning change in the thematic area to capture that. Now, this looks at it in a different way. This is the bull market. Historically, when we've had bull markets, which segment has outperformed? And you can see the dark blue is the S&P 500 cap-weighted returns. And you can see that typically in a bull market, the equal weight and the small cap stocks outperform the S&P 500. In fact, in every occasion, historically, for every bull market. However, in this one, you can see that the blue line with the circle is dark blue is the S&P 500 is outperformed. So this is an inverted leadership compared to history. And what that means to us is that there's going to be opportunity in the other stocks outside the big tech companies in the future. We call this reversion to the mean, and that's where it should normalize when some group that's been underperforming and shouldn't be underperforming will eventually start to outperform. And that's why we've positioned our thematic side for this to capture this. And it's working out actually very well compared to the high growth we were in, which is down significantly. But we've been able to protect the thematic returns. And that's by taking advantage of this potential reversion of the mean, which we think is already beginning to start. Now, how about small stocks? Are they going to revert? We don't think so. And here's the reasons why. Small companies' debt, what percent is in floating loans? That means their debt that they have to pay to run their companies is adjusting every day or in a floating rate loan, which means their debt service is rising dramatically. And you can see the percent on the far right. The Fed Small Business Lending Survey shows that about 63% of companies have floating rate loans in the small company area. This is going to put a lot of resistance and headwinds in the small companies able to continue to make profits because they're paying a lot, maybe 3-4 times what they did before for their debt service. Another chart, this is from BlackRock, shows that if you look at the circle, you can see if the line is going down, this is showing that the tightening of lenders to loan to small companies. And you can see the yellow line has dropped significantly, which means there's a lot of restriction in loaning to companies, especially small companies. And what that means is small companies may have a tough time getting loans, or they may have to pay a premium in interest rates, which will pressure their earnings. Now, large companies, it's not that case, because during this year, 23, large companies paid down their debt because they expected a recession, like most of the strategists. Well, it never came. So they've gotten their balance sheets overall in pretty good shape. So they won't be as impacted as small companies. So this is why we don't like small companies, even though there should be a reversion of the mean. But we think it probably will not happen until we go through a recession, and maybe halfway through the recession we believe is coming next year. Then they'll be more attractive. But we would stay away from small caps at this point because of their amount of money they have in interest rates that are going up fast, and also the tightening conditions of getting financing. So why are interest rates spiking? Now you got to remember that that question was asked to Federal Reserve Chairman Powell, and he said, "I don't know why." So I'm not going to say that we know why, but here are some of the reasons. Number one is the Federal Reserve balance sheet. They've been a net seller of bonds, treasury bonds. So they're selling bonds, which means that there's more pressure on the bonds prices to go up because there's more sellers out there. Another reason is that Japan, which is a big buyer of our 10-year, of our government bonds, their own treasuries are going up. So the 10-year government, you can see, has been rising. So the Japanese are now there's more competition to buy their own treasuries versus U.S. treasuries. Another reason is that the resilience of the U.S. economy. That's another one. When retail sales came in better than expected, and we're expecting a strong GDP number coming out here very soon, that this is another reason why the resilience of the economy, why yields have been going up so fast. Now, when will rates come down? And here's a chart that shows that when the Fed is done, that rates come down. Now you can see the Federal Reserve fund rate is the yellow line, and you can see the Treasury yields are the blue line. And when they're done, you can see the circles, the yellow circles in all these cases, even before the Fed is done, that typically yields come down before the Fed's done or before they're finally done. However, look at the far right. You can see how fast that line went up, the Federal Reserve yellow line on the far right. It went up faster than history. But when is the yields, or when are the yields going to come down? Well, if history is repeatable, then we'll see the Fed, when they stop, this line's going to come down. So that's why we've been saying, that's one of the reasons we're bullish, is that when the Fed's done, stocks rally and bonds rally because yields are coming down. Okay, this is another look at how long-term treasuries, a 20-plus year treasury bond, is down 50.4%. This is setting up for a massive bull market in long-term treasuries. And there's a lot of reasons to counter this. One is that there are fewer buyers for long-term treasuries, and a lot of the other factors we looked at. But when this stops, which we think is very soon, there's going to be some opportunity for those risk takers to get into long-term treasuries. You can see that it's down 50.4%. We think that's going to come to an end here soon. And if the Middle East goes into an expansive war, this will begin to rally very fast. All treasuries will rally fast, a flight to safety. So this is unusual. We haven't seen a drawdown like this historically. You can see the average drop in the long-term treasuries is 18.5. So this is an unprecedented drop in treasuries, which means there could be a massive opportunity in treasury bonds. All right, this we're shifting. This is a chart that I saw. This is interesting. It's a chart on, hey, should you be buying a house or renting a house? Well, you can see that it's become much more favorable for renters to rent. Pricing for rentals is a much better compared to buying a house. So we'll see how that impacts the housing market. But if you're out there and you're saying, should I buy or rent? Well, here's a chart that says you should rent. And for those that are in that position. Okay, so what's our outlook for the rest of this year? We do think wag the dog finally happens, that the Fed's going to stop. So here we believe inflation will continue to fall. We believe the Fed will stop raising rates. We don't see, the investors don't see that at 100%, but they're going to, I believe, end, which means the tail finally wags the dog. It's a much later than we expected, but we do think it's going to happen in the near future. So they're going to stop raising rates. Stocks will rally because of that fact until the end of the year. Bond yields fall. And what happens is bonds start to rally after their huge losses this year. Huge amounts of cash on the sidelines enter the market, bolstering second half stock rally. Here's our caveat. No geopolitical forecast. It's impossible to determine what's going to happen in the Middle East and whether it's going to expand or not. So this could change all our expected outcomes. So we're going to put that in there. That's our disclaimer. We have to readjust everything if it expands. Now, the S&P forecast for the 500 is, we're saying 4,600 by year, and that was our original target. And remember, we just went over 4,600 for a few days, but we did reach it once before. We thought then we better raise that, but now we're back to 4,600. We think that will be once again reached if everything goes right. If we do go into an expanded war, all this is off the table, and we'll be making adjustments accordingly to the portfolios. So we've lowered to our initial forecasts. We do believe that stocks will peak sometime in December or January, as we said last month. And then our surprise forecast, we want to recapitulate that. This is what we see happening in the first half of next year because of excess savings from the pandemic run out, loan payments for students, consumer spending will roll over, service PMI will go into contraction. That means people will slow down their traveling habits after being bound up during the pandemic. Fed aggressive rate hike campaign overshoots. We do believe that's going to happen. Delayed impact on economy ends up hurting economy more than expected. Corporate earnings fall. Stocks go into correction or maybe even a bear market in the first half of 24. Bonds rally. Economy starts to recover, however, in the third or fourth quarter of 24. So we don't think it lasts the whole year. We think it's the beginning of the front end of the year, and then as normal, stocks start to recover in the second half, probably the fourth quarter or maybe the latter part of the third quarter. So that's our forecast for 24. Actually, there's a growing number of I wanted to get this out early. We put it out about 2 months ago because now there's more and more economists starting to agree with us that things are going to roll over. I like to be on the front end of the forecast. Now, I want to say this, that the portfolios and how we manage the portfolios will be data driven. So we don't automatically change the portfolios for this scenario until we see evidence in the upcoming data that's coming economically, earnings wise. So we got to see some signs before we'll adjust the portfolio. We'll make some minor adjustments perhaps, but we won't go full boat into this forecast until we actually see the data start coming in.
Very good reminder, Tom. Absolutely. Thank you very much for that objective review. Always appreciate the well-balanced view and information that you bring to us. So with that, I'm going to open up to any questions that people have. So if you have a question, feel free to shoot me an email. Feel free to shoot me to post a question in the comments section. Would be happy to field those for you. I did have one question come in. I'm going to bring up a little bit of a slide to help here, kind of on the fly. So the question was, noticed on my statement, noticed in some reporting that there was a pullback in wide moat for September. And the question is, how concerned should I be? So I have a slide here that I can show what happened with wide moat. So this is wide moat year to date by month. So if you start at the top, that's January is the up 5.91%, and then February was down 0.54, and so on. So the comment is referring to that negative 4.6% in September, and then the yellow or the gold there references the S&P 500 and what it did, and then the difference there. So Tom, what would you have to say to that concerned investor out there?
Yeah, we just had a spike in interest rates, which hit the technology sector harder than the rest of our positioning. And we do have a slight overweight to technology stocks, and there's good reasons for that. And so that brought down the return this year. But there's really been no place to hide. Just the S&P 500's down, we're down. And so much of this was not predicted. The reason, it's because of the geopolitical events, the unexplained spike in interest rates, and other things going on. But however, the economy to date has been amazing. I mean, retail sales came out better than expected. And so there's a lot of the economic engine still working very well. So there's a lot of pluses and minuses, but much of this was caused by the spike in interest rates that occurred. And it was unprecedented. You could just see within 1 week, it was up 40 basis points. And this caused the technology segment of our portfolio to go down. And a lot of the other ones held up some because we have one of the things about wide moat is we have a lot of diversification. we've got companies like Johnson and Johnson, Coca-Cola, and some other companies like defense stocks, which are doing very well. But because we have a little slight overweighting to technology, that's probably why it came down. Do we think that's going to continue? It all depends what happens overseas. But our scenario is that the Fed will stop between now and the end of the year. So what we've lost here, we do believe will recover. Now, again, it all depends on what happens overseas. Geopolitical events are impossible to predict, so we can't predict that, but we will adjust the portfolios if we see things starting to decay. And we're prepared. Eric and I have been talking about it to put a hedge on our wide mode portfolio, and we've already set up the scenario, and so we can do that at any time. But I'm not convinced this is the end of stocks this year. So we've had a bad month, but they come and go. You can see that we had a bad month. What month is that, Eric?
4.6 was September.
4.6. So it's happened before, and actually followed a minus 1.8. So you can see we can have a month or 2 months negative, and then it pops back. So we'll have to see what happens, but we're ready to go. So I wouldn't be concerned, because we're on the other side. We're thinking about this also. How can we preserve your portfolio? So we're always looking at that every day.
Absolutely. That's a very important reminder that stock investing is volatile. It goes up, it goes down. This is looking at a year-to-date chart. The blue line is wide moat. The gold line is the S&P 500. So you can see we are outperforming the S&P 500. On that last chart, we can see a year-to-date by 5.17%. But if we look at this chart here, you can see that peak that is being referenced there, kind of end of July into August there, if we're just looking at a monthly return. So we were up about 24% year-to-date because we stayed invested this year, and today we stand at about 17%. So this was, if we go back to that, 17.06% down there at the bottom, the blue column. So, yep, we've seen some pullback, and that is just a good reminder, Tom, that the stock market goes up, the stock market goes down, and over time we're looking for that outperformance.
Absolutely.
Okay. Yeah. So thank you. Any other questions for those of you? I see a number of you out there. So thank you again for taking the time to be here, watching my email, watching the comment section. Any other questions out there that we can bring to Tom? I'm not seeing anything right now, Tom. I'll keep watching if anybody wants to post something. And again, if you're watching this in the recording, we'd love to field those questions. So please don't hesitate. Those do come to me. I am watching those. So don't hesitate to post any questions that you have. If you'd rather, feel free to directly email me as well. So with that, maybe going once, going twice. Tom, any last comments you want to add before I kind of wrap us up?
Yes. The markets are always volatile. As Eric said, we have ups and downs. We haven't seen enough evidence to lower our positioning in equities yet. We do think that technology will remain some of the strongest segments of the market, and specifically because of the AI revolution that's occurring. That's going to benefit technology first, and then it will eventually get down to some of the other companies that utilize it. And all the other companies and all the industries are right now trying to figure out, how can I use this advancement in AI? And so that may take a year, but we are already moving towards companies that haven't done well, like dividend stocks or the equal weight of the S&P 500, which is underperformed. So we've already made that in the thematic. So we're already starting the positioning to be more defensive.
Excellent. And as Tom said, we'll continue to keep our thumb on the pulse of what's going on, stay data dependent on those decisions. As you look ahead on the calendar, mark your calendar. Thursday, November 16th will be our next monthly check-in like this here today. So we'll have the Fed decision behind us and a couple of weeks to let that simmer. and we'll see where things are at that point. So mark your calendar, Thursday, November 16th. We will be live in person at our office here in Eden Prairie. Welcome to join us for lunch. We'll also be streaming online as always as well. For those of you that are joining me Monday mornings, I also do that short recap of what happened in the markets the previous week. So if you're not joining me, I would love to see you on those short updates Monday mornings. I also send an email out later on Monday afternoons. So if you're not getting that email and you would like it, you can head over to the website and subscribe to that email list, and I'll send you a link to that video when we're done as well. So with that, I'll go ahead and sign us off and just say again, thank you everyone so much for taking the time out of your busy schedule. Thank you, Tom, as always. Really appreciate you with all the wisdom that you bring, making sense of everything that's going on in the world. And with that, I'll sign us off. So everybody, have a wonderful rest of your day.
Thank you, Eric.